Listen up, because what's happening in the precious metals market right now isn't something you see every day. We're witnessing movements that typically show up during major financial shifts, and if you're not paying attention, you might miss what these signals are actually telling us. Before we dive in, quick note, I've put together a community for people who want consistent market updates. There's a link below if you're interested in staying informed with regular analysis. Takes just a moment to join. Here's something I'm doing this month. I'm giving away some physical silver to one lucky viewer. To participate, hit the like button, subscribe to the channel, and leave a comment telling me either what form of silver you prefer or where you think prices are headed this year. I'll announce the winner in a live stream at month's end. Simple as that. But let's be clear, this giveaway isn't the main event. The main event is understanding what it means when precious metals reach levels most people thought were years away, while everyday life appears completely normal on the surface. Think about it. You're still buying groceries. The stock market is still functioning. Most people are going about their regular routines. Yet something fundamental has shifted beneath the surface. Current market data shows silver trading around $115 per ounce, with intraday spikes pushing even higher. Gold is above $5,200. These aren't casual numbers, they're alarm bells. So the real question isn't, did prices go up? The question is, why are prices moving like this before we see obvious crisis signals in mainstream news? Keep that in mind, because I'm about to explain the one indicator almost everyone overlooks, and it's the key to understanding whether this is temporary volatility or the beginning of a completely different financial era. Quick reminder, check the description for additional resources, including a premium community link and membership options. Premium members get exclusive videos from a dedicated research team with deeper analysis and more detailed breakdowns. Worth considering, because the coming months will reward those who prepare rather than those who simply react. Understanding the current situation. Let me break down what's happening without the hype or fear-mongering you'll find elsewhere. I spoke with someone deeply knowledgeable about monetary mechanics, not just price charts. My first comment was, "Tell me this isn't as concerning as it feels. Prices are soaring, yet I'm still uneasy." His response wasn't reassuring. He compared it to watching storm clouds gather while people continue setting up for a picnic. Here's the critical distinction most people miss. When silver surges vertically like this, it's not necessarily silver gaining value. It's the dollar losing purchasing power. That's a harsh reality many still don't grasp. If silver reaches $150, but simultaneously your rent doubles, insurance triples, and your paycheck buys half as much, have you actually profited? Or have you merely maintained your position while everything around you inflates? This is why I emphasize, don't obsess over the dollar value of your metals. Focus on what those dollars represent in real purchasing power. Right now, the dollar is losing value at an accelerating pace. According to current publicly available information, the central bank is maintaining interest rates in a middle zone, high enough to create pressure, but not high enough to truly stabilize the system. They're applying pressure and then acting surprised when something breaks under that strain. We discussed what would signal the true endgame scenario. The answer was straightforward. You'll recognize it when the next major intervention happens. Not subtle policy adjustments or technical tweaks. I'm talking about the moment they slash rates back towards zero and inject fresh trillions into the financial system, because banking infrastructure starts failing. That's when the facade drops. Here's what should concern you. Silver is currently making moves that historically occur after that kind of massive intervention. So why is it happening before? That's the question worth pondering. If silver is anticipating the bailout, it suggests those closest to the financial system's inner workings are seeing something the general public hasn't noticed yet. Does this mean imminent collapse? Not necessarily, but it does mean the risk level just escalated significantly. Physical vs. paper metals. Let me challenge something commonly repeated in precious metal circles, even by people I respect. Paper metals won't matter. Only physical counts. Derivatives will become worthless. Here's my perspective. In a genuine system breakdown, yes, counterparty risk becomes enormous. A contract is only valuable if the system enforces it. However, markets can remain functional longer than many expect, and paper exposure can serve useful purposes as a transitional tool. I'm not here to prescribe a one-size-fits-all approach. I'm here to say, understand what you own, why you own it, and what conditions must exist for it to function as intended. Physical metals represent sovereignty, a tangible hedge you control directly. Paper exposure offers liquidity and flexibility until it doesn't. The danger isn't owning an ETF. The danger is believing an ETF is equivalent to physical metal in your possession. These are fundamentally different assets, and the faster prices move, the more that distinction matters. My contact said something that really resonated. This is separating investors from those who are exiting the system. That's the clearest way I've heard it expressed. Some people buy metals trying to increase their account balance. Others buy metals because they no longer trust the measurement system itself. When that measurement system starts distorting, the second group stops caring about daily quotes. They start counting ounces like lifeboats. Volatility and corrections. Even if you're in the exit camp, you still face one practical reality: volatility. Silver doesn't rise smoothly. It moves like a malfunctioning elevator, up fast, down fast, then up again. We discussed corrections, and I'll be honest, a sharp pullback wouldn't surprise me at all. It might be the most normal development possible. What matters isn't whether a correction happens. What matters is what happens after the correction. There are corrections that simply represent a pause. And there are corrections that represent your last opportunity. You won't know which type it is until it's already passed. If you found success with your strategy, share it in the comments to help motivate others. Understanding price. Divergence. Now let's address something confusing many people today. Why are there different prices depending on where you look? People keep asking, the paper quote shows one price, but the real-world physical price is higher. Is this a shortage? Is the market breaking? The explanation isn't complicated, but it requires understanding that there are essentially multiple silver markets that only appear unified during calm periods. When tension increases, they start diverging. One market is retail coins, people buying physical pieces they can hold, trade, and store. Another market is industrial, companies needing specific forms for manufacturing. They can't use random coins, they need refined products. A third market is futures and warehouse contracts, delivery rules, inventories, and the legal framework maintaining spot prices. During calm times, these markets run parallel. During stress, they pull apart. An industrial buyer can't show up with mixed coins and say, make my components. They need refined bars of particular purity. They need reliable supply chains. So even if retail coin premiums remain reasonable, industrial premiums can spike dramatically. When manufacturing operations are competing for supply, they'll pay premium prices because the cost of not getting the material exceeds the cost of paying more. This creates a world where one price appears on screens while desperate buyers pay significantly more in reality. When those prices start diverging, it signals the market's infrastructure is under strain. Current position versus endgame. Here's the uncomfortable question. Is this movement happening because we're already in the endgame, or is this a preview? The assessment leaned toward preview. The world isn't panicking yet. We're not seeing obvious symptoms that appear when currency fails publicly. No empty shelves, no daily price repricing at checkout counters, no mass rush into physical goods. If those things aren't happening, why is silver acting like they are? That's when I heard something that stopped the conversation. If silver can do this while the public is still asleep, imagine what happens when they wake up. That sentence sits heavily because it suggests the current movement might not be the major move. It might just be the preview. What could trigger a pullback? To stay grounded, let's discuss what could create a pullback. When prices explode, major industrial players and leveraged traders scramble. Some buy because they genuinely need supply, others buy fearing they won't access supply later, but these same players often have obligations denominated in dollars. When financial conditions tighten, those obligations persist. This can create moments where the system demands dollars urgently, a dollar crunch. During a dollar crunch, even people who value silver might sell it to raise dollars, not because they've changed their mind about silver, but because the system forces their hand. That's how violent downswings occur. This is why I refuse to promise it only goes up from here. Anyone making that promise is selling comfort, not truth. Here's reality. I don't know the exact top of the next spike, the exact bottom of the next dip, or the precise day the next policy shift occurs. Neither does anyone else. What I can do is map the logic. The more fragile the dollar system becomes, the more valuable real assets become, and the more chaotic the path between here and there gets. Practical advice for new participants. If someone is brand new and watching this feeling like they're late, what should they do? The advice is almost boring, which is why it's good. Don't try to time your first step perfectly. Acquire a first position. Start small if necessary, but start. The goal isn't winning a perfect entry point. The goal is not being empty-handed if the system has a crisis. Once you have your base position, stop obsessing over it. Stop doom scrolling. Stop refreshing prices every 10 minutes. Build your life, develop your skills, increase your income. Check back when you have new capital to allocate. Obsession transforms preparation into panic. Panic leads to poor decisions. I'll add my own layer. If you're new, don't let a triple-digit price convince you silver is expensive. Price isn't the same as value. A high quote can indicate a sick currency, not an overvalued metal. Instead of asking, is it too late? Ask, what problem am I trying to solve? If you're addressing currency debasement and purchasing power erosion, the question isn't whether the quote is high. The question is whether the policies causing this are stopping. Based on recently published data and statements, confidence in the dollar isn't exactly strengthening. Some might think I'm being dramatic. Am I? Gold pushing above $5,200 isn't routine. Silver holding around $115 isn't routine. The striking part is that most people aren't treating it as an emergency. That mismatch between market behavior and public awareness makes this situation potentially explosive. When public awareness finally catches up, movements tend to accelerate dramatically. Gold-silver ratio context. The gold to silver ratio has been compressing, meaning silver is outperforming gold. In simpler terms, silver is strengthening relative to gold. This happens for several reasons: monetary demand, industrial demand, speculative pressure, or all simultaneously. When everything hits at once, you get what we're witnessing, a violent repricing. But here's a counterpoint to prevent getting hypnotized. A falling ratio doesn't guarantee a straight path. It can overshoot, snap back, or fake you out. If your entire plan depends on a ratio reaching some magical number, you're building on unstable ground. Use ratios as temperature gauges, not prophecies. A personal story about patience. Let me share a relevant story that provides emotional context for what we're experiencing. I remember a serious silver purchase made when prices were in the 20s. The buyer watched it go nowhere for years. That's the part nobody wants to hear during euphoric periods: patience. Preparation is boring until it isn't. Then it looks like genius. My first purchase was around the high teens in US dollar terms. Same feeling. You buy, feel smart briefly, then the market ignores you. But markets reward those who can remain patient. Not forever, just longer than average attention spans. Right now, average attention span is about 8 seconds. If you're here because silver is trending, fine. But don't leave when it stops trending, because the moment everyone stops watching is usually when real positioning occurs. Daily life implications. What does this mean for day-to-day life? If you only care about bigger numbers on screens, you're missing the real story. When metals surge, it often reflects breaking trust. Trust in purchasing power, fiscal discipline, the idea that savings will be rewarded. When that trust breaks, behavior changes. People stop lending. People stop holding cash. People move into things that can't be printed. That shift drives the second phase of movement, often the larger phase. Are we in the first phase where smart money moves quietly, or the second phase where crowds stampede? Share your thoughts in the comments. Are we early or late? Second question, if silver suddenly dropped 20-30%, would you see that as disaster or opportunity? Be honest. Comments are open. Fundamental analysis. Silver is unusual because it's both a monetary metal and an industrial input. It gets pulled by two different forces: the monetary engine, fear, trust, policy, psychology; the industrial engine, factories, supply chains, real-world demand. When both engines accelerate simultaneously, prices don't rise politely, they snap. You can feel both engines revving now. Monetary side, gold breaking records, dollar weakening, uncertainty rising. Industrial side, ongoing demand for electronics, energy infrastructure, high specification manufacturing that can't easily substitute silver. I'm not claiming silver is the only answer. Real estate, productive businesses, skills, and cash flow matter. But silver is one of the clearest indicators of currency health. Right now, that indicator is showing something concerning. Addressing FOMO. If you're feeling FOMO, fear of missing out, understand this. FOMO is how people buy at short-term tops, not because they're unintelligent, but because they're human. They see charts, feel urgency, and press buttons with shaking hands. If that's you currently, pause. Return to first principles. What percentage of net worth do you want in hard assets? What percentage liquid? What's your timeline? What would make you sell? If you can't answer these questions, you're not investing or preparing. You're gambling. Gambling gets punished in volatile markets. Understanding. Endgame. Let's clarify endgame, since it gets thrown around casually. Endgame isn't a date. Endgame is a sequence, a chain reaction where one policy move forces another. One bailout forces another. One confidence break leads to another. Eventually, the system becomes addicted to its own medicine, and dosages must keep increasing. That's what hyper-unstable systems do. When someone says, "We're not there yet," I understand the caution. When they say, "We're heading there," I understand the conviction, because we've seen this pattern throughout history. Currencies rarely die in one dramatic explosion. They die in episodes: crisis, patch, calm, bigger crisis, bigger patch. Each patch makes the next crisis worse until patches stop working. Identifying catalysts. You might wonder, what's the catalyst this time? That's a dangerous question because people want a single trigger. Reality usually involves multiple stresses stacking simultaneously: debt servicing costs, political pressure, trade imbalances, bank exposure, consumer confidence cracks, employment shifts. Then something everyone thought was manageable suddenly becomes urgent. Based on recently published data, sentiment around the dollar has been unstable, visible in how aggressively safe haven assets are being purchased. Here's my skeptical alternative. Not every metal spike equals immediate collapse. Sometimes metals spike because positioning is thin, sometimes they spike because speculative flows avalanche, sometimes they spike because markets are anticipating policy decisions that end up less dramatic than feared. Respect the signal, but don't let it hypnotize you. Use it to refine your plan. The overlooked clue. Remember when I mentioned the one clue most people ignore? Here it is. The clue isn't just price, it's timing. Silver and gold are acting like a major policy shift is imminent. When markets behave this way, they're either early or informed. We're sitting on a central bank decision window right now. Even if the official statement is steady, markets are detecting something else. Perhaps future cuts, perhaps future liquidity, perhaps stress behind the scenes. Whatever it is, markets aren't waiting for press conferences. They're moving first. If you wait for press conferences, you're always late. Watch actions, not words. Waiting for pullbacks. For those saying, I'll wait for the pullback, I understand, it feels prudent. Here's the trap. If you wait for the pullback and it never materializes the way you expect, you end up doing nothing. Doing nothing is still a decision. Instead of all in now or wait forever, consider a middle path, scaling. Buy a little, then more on dips, then more when possible. This approach removes the emotional pressure of picking perfect bottoms. Disclaimer, don't confuse strategy with guarantee. Scaling doesn't protect from volatility, it protects from paralysis. Big difference. Too high argument. Let's address the it's too high argument. Prices become too high two ways. The asset becomes overvalued relative to reality. The currency becomes devalued relative to reality. Most people only understand the first, but the second matters more in an era of constant policy improvisation. That's why metals can appear crazy while actually being perfectly rational. If the measuring stick shrinks, numbers rise. Behavioral questions. If silver can hit $150 with no obvious public panic, what happens if major banking headlines hit on a Monday morning? Do buyers calmly wait for dips, or do they hit buy buttons like fire alarms? These moments matter because they're not just about price, they're about behavior. Complexity. Warning. In fast markets, people get tempted by complex strategies. Leverage, options, exotic products. I won't moralize, but I will warn. Complexity is a multiplier. It multiplies gains, losses, and stress. If you lack experience managing that stress, markets like this will humble you quickly. If you're new, keep it simple. If you're experienced, stay disciplined. If you're emotional, step back. The fastest way to lose money in metals mania is treating it like a video game. Credibility breaks. Earlier I mentioned after the final correction, that's it. That's dramatic, and it resonates because it's frightening. Here's my refinement. The final correction is only final if the system's credibility breaks beyond repair. Credibility breaks when people stop believing promises. We'll control inflation. Your deposits are safe. We can normalize later. Watch credibility. When it vanishes, markets don't politely reprice. They stampede. Personal rule. One of my personal rules for moments like this. Never assume the first big move is the last big move. Markets love to shock you, bore you, then shock you again. They spike, chop, then spike harder. They do this to transfer assets from impatient hands to patient hands. If you're feeling euphoria, you're at risk. If you're feeling despair, you're also at risk. The goal is calm. Calm people make decisions. Core recap. Quick recap for those just joining. Silver is surging not because silver suddenly improved, but because the currency and trust environment is deteriorating. Physical and paper markets diverge when supply chains strain. Corrections are normal, but post-correction behavior matters most. Timing suggests markets are anticipating policy stress or liquidity shifts. That's the map. For those feeling anxious. For anyone watching this late at night with a tight feeling in your stomach, I understand. Money touches everything: family, future, dignity. When money feels unstable, life feels unstable. Don't let this become an anxiety spiral. Make it a planning moment. Create realistic budgets. Eliminate waste. Build emergency funds. Reduce bad debt. Add measured hard assets. Invest in skills. The endgame isn't won by whoever has the spiciest social media takes. It's won by whoever has the strongest foundation. Share your success stories and comments to help motivate others. The optionality. Mindset. During a past crisis, someone advised their father to buy silver. Not because it was guaranteed to bounce next week, but because it was affordable insurance. The father bought, paid premiums because demand was intense, and time did the rest. That's the mentality. You're not buying lottery tickets, you're buying optionality. Optionality matters when systems wobble. What to watch next? Since I'm recording this late, let me give you a framework for what to watch in the next 12 hours, because they matter more than the last 12 days. First, central bank decisions. There's a decision window approaching. Even if rates don't change, markets don't just react to actions, they react to hints about future actions. If language shifts even slightly toward "we're concerned," metals can treat that as permission. If they sound stubborn, metals can still run if traders anticipate something breaking anyway. The market is daring policymakers to keep braking while the engine overheats. Current interest rate targets sit in the 3.5% to 3.75% zone, tight enough to squeeze borrowers, loose enough to keep the debt machine functioning. If they hint at easing, metals can sprint. If they don't, something else might break. Either outcome maintains volatility. Second, the dollar. You don't need advanced degrees to understand this. When the dollar drops, dollar-priced commodities usually rise. But what's happening now feels more psychological than mathematical. It's not just currency exchange movements, it's people quietly questioning whether holding cash remains smart default behavior. That's when gold and silver stop behaving like trades and start behaving like lifeboats. Third, spread between screen prices and physical acquisition prices. If coin premiums stay calm while industrial premiums jump, stress is in supply chains, not retail panic. If both jump together, the crowd is waking up. If premiums collapse while spot stays high, the spike might be mostly leverage driven. Each scenario tells a different story. Fourth, post-pullback behavior. This is where people get fooled. Violent dips can feel like parties ending, but sometimes they're just markets clearing weak hands before the next surge. Watch the bounce. Does it snap back fast, suggesting waiting buyers, or does it drift, suggesting evaporated demand? The answer distinguishes temporary fever from structural repricing. Position sizing. Here's what most people won't like. Even if your long-term thesis is correct, you can still get hurt short-term if you size positions wrong. Plan your position so you can sleep. If your metals position keeps you staring at ceilings, it's too large, or your cash buffer is too small, or both. Hype vs. fundamentals. Let's address the silver is only up because of hype argument. I don't buy it. Hype can move prices, sure, but hype doesn't manufacture new industrial supply. Hype doesn't create more refined inventory. Hype doesn't magically replace silver in high-performance electronics overnight. If demand is genuine and supply is tight, hype just lights fuses faster. Simultaneously, I don't buy the opposite extreme, that every uptick proves immediate dollar collapse. Systems can limp, patch, and stagger longer than internet commentators think. My posture: stay alert, stay humble, stay positioned. But don't get intoxicated. Managing gains. If your metals jump and you feel wealthier, don't rush to celebrate. Ask yourself, did purchasing power improve, or did the scoreboard change? If taking profits, do it for reasons. Paying high interest debt, building cash cushions, shifting into other understood hard assets. Not because you're bored. If holding, make peace with messy paths. That's not a flaw. That's silver's nature. Final message. Watch what happens next, because the next headline could make today look like warm-up. Don't let soaring prices distract from the real message. Old rules are being quietly rewritten. First in markets, then in headlines, then in daily life. If you understand that sequence, you won't be surprised. If you aren't surprised, you won't panic. If you don't panic, you'll be ahead of most people. See you in the next video. Disclaimer: this video is for education and perspective only. I'm sharing how I analyze fast-moving markets, not telling you what to buy or sell. Make choices based on your own situation, risk tolerance, and if needed, qualified professionals you trust.